As far as the negative net worth sort of question is concerned, it's a non-event, and I know it's going to sound a little bit flippant, but it is a non-event.
Cash reserves may have vanished, but Indigo remains unperturbed ahead of its IPO. President Aditya Ghosh calls it a non-issue. The listing is scheduled for the 27th of this month, and the share will cost between 700 to 765 rupees a share.
Growth engines continue to misfire in China. Third quarter GDP slows to 6.9%, the lowest in 6 years. Factory output remains tepid despite stimulus measures and rate cuts.
17 months in power, but the Modi government is yet to infuse. Rating agency S&P retains India's BBB- rating with stable outlook.
The IMF is supposed to look at these things in a global sense. But the IMF has been sitting on the sidelines applauding these kinds of policies right from when they were initiated.
Governor Rajan lashes out at his former employer, urges the International Monetary Fund to speak out against easy money policy adopted by developed economies.
HCL Tech misses the mark with its quarterly earnings. Dollar revenues miss estimates and profits meet moderate forecasts. Ultratech delivers an operational beat in the second quarter as volumes perk up.
It's the third acquisition in 9 months. Vishal Sikka and Infosys continue their shopping spree. Lap up US-based IT management firm Noah Consulting for $70 million.
2 days after Maggi got the clean chit from 3 labs, Gujarat and Karnataka lift the ban on the instant noodle, but the central regulator's ban continues.
In the next 12 months, we should go back. In fact, in the next 3 or 4 months, I hope we'll go back to the old high of 9,000.
Optimism resurfaces as the bulls continue to march ahead on the Lal Street. Pankaj Vaishya of Citi believes 9,000 for the Nifty is not far away.
DLF moves faster to sell its rental business and ease the debt burden. Sources say the company is in talks with 5 private equity firms to raise up to $2 billion. The stock rises after the CNBC TV 18 exclusive report.
Andhra Pradesh is all set to start construction of its new capital city. We take you inside the 400-acre land parcel where a sprawling city called Amravati is set to be built.
Do the state governments really have the capacity at this point in time to be able to deal with that kind of debt?
The promoter of a company has to bear the burden of the cost. Yeah. These state discoms are owned by the state.
Getting FDI and Make in India, the timing is not necessarily correlated. It is DPP 2015, so before December month, there is in November.
Whatever the problem in administrative level, it is ultimately the responsibility of the political leadership to improve that. We need the investment to come from different places. We are trying to reorganize the system within all the limitations. And therefore, all of this is happening. And for that, what we really need is the patience as well as the participation. Both P's are important. And therefore, if both the P's are there, then we'll be able to definitely make it happen. And I know we need more Shireen Bhans in the system where we can actually take it forward.
More Shireen Bhans will make India better. No, Shireen, I'm not saying that to suck up to you. These were not my words. These are the words of the Railway Minister, Suresh Prabhu. Good evening and welcome to India Business Hour. I'm Nayantara Rai and with me, none other than Shireen Bhan. Shireen, what are you asking the government today?
Well, I asked the previous government plenty of questions, Nayantara, but we're just doing our job. Good evening. Thanks very much for joining us on this new edition of India Business Hour, and do tell us what you think of our show. But before we get started, here's a quick check of the market action where the bulls continue to march ahead on the Lal Street. The market gaining ground for the third straight day with heavyweights leading from the front. The Nifty gained over 35 points and it now moves closer to the 8,300 mark. The Sensex has put on about 150 points, is now comfortably above the 27,000 mark. Mid-caps outperforming the blue chips today with the mid-cap index gaining over 100 points. It's looking good on the Lal Street and the optimism seems to have resurfaced. Pankaj Vaishya of Citi, speaking exclusively to CNBC TV 18, says Citi expects the Nifty to touch 9,000 in the next 3 to 4 months. Samir Arora of Helios Capital has simple advice: forget the government and focus on stocks.
I think, in the next 12 months, we should go back. In fact, in the next 3 or 4 months, I hope we'll go back to the old high of 9,000. And then depending on what happens in the Rajya Sabha makeup. I think then we should be on our way higher. But let's just first see us regain the old high, which we should.
On a big picture basis, relative to the world, India has done very well, and there's a logical reason for that, because India is in a different cycle in terms of interest rates being cut and things like that. I think the government has not done the maximum that it could, but it has done reasonable. And my feeling is that at the end of the day, whenever we have tried to depend too much on the government, which I have not depended in the past, in a specific sector sense, people have not made money.
Let's do market veterans' advice on how you can play and approach the large street. Ratings company S&P affirmed India's sovereign credit rating at BBB-. The rating agency has a kind word for the Narendra Modi government's efforts to improve the business climate, but not enough to warrant an upgrade. Lata Venkatesh now joining us to tell us what else S&P had to say. Over to you, Lata.
Basically, when the Modi government came in, there was a lot of hope that economic and financial fiscal performance will improve and there'll be a rating upgrade. Basically, today S&P scorches that. It doesn't say there is anything for a downgrade at all. Profile is good enough, but not enough for an upgrade. It says the rationale for maintaining it at BBB- is that the external condition is very good. Monetary credibility, which means the inflation situation is stable, democracy and policy predictability, but on the negative are the high fiscal deficit. It, however, has some kind words, of course, for the Modi government, but not enough to warrant a rating upgrade. External position is the best according to S&P. That is the best part of India's rating profile. Current account deficit expected to be about 1.4% this year and up until 2018. But the negatives will be that India has a very low per capita GDP compared to other countries in the same group, that is BBB-, just $1,700 per capita per person. It says that the high fiscal deficit is the other constraint. It has improved. It was 8.8% if you take the last 20-year average, but it is 7.4% if you take the last 5-year average. Of course, S&P includes the state government's debt as well when it counts fiscal deficit. It says that in the current year, planned revenues may not entirely materialize and subsidy cuts could be delayed. So a bit of a question mark on this year's fiscal deficit as well.
All right, Lata, thanks very much for detailing S&P's outlook. Status quo as far as the outlook is concerned. But here's the big global story. Promises from Beijing, repeated rate cuts and stimulus measures have all failed to lift the Chinese economy from its slumber. However, the growth rate of 6.9% has beaten expectations for the third quarter. But this is also the slowest pace of growth since the 6.2% amidst the global recession in 2009. Industrial production in September has dipped to 5.7%. This is below expectations and well below the 6.1% clocked in August. Eunice Yoon reports from Beijing that industries in China are still not finding traction and that it could in fact be a long road to recovery.
I think what we saw from the data is that China is experiencing an industrial slump. There are traditionally strong sectors such as housing construction and manufacturing are struggling, and that doesn't bode well for the overall economy.
At her factory in central China, manufacturer Maggi Ma is bracing for tough times. Her company makes clothing for big brands like The Gap. With sales slowing overseas, Ma had hoped to sell into China. No such luck. Domestic consumers are doing okay, but high inventory is inevitable, she says. The manufacturing industry in China is suffering. Many companies in China are coping with too much inventory. The economy here is slowing down. Industries such as steel and cement are burdened with overcapacity, while property developments struggle to attract new buyers, raising fears the Chinese slowdown could become a major risk to the global economy. China has skyrocketed on the list of investor concerns due to the recent stock market tumble, disappointing data, and a surprise devaluation of the yuan, which officials say helped cushion sales for manufacturers like Ma. With the economy poised to miss its annual growth target of about 7%, pressure is growing for the nation's leaders to step up measures to stimulate the economy, policies that could be announced around an October conference outlining development plans for the next 5 years. Building more trains and highways as part of a government push to rebuild old trade routes, an initiative dubbed the New Silk Road, is expected to be on the agenda. Infrastructure spending that Ma would welcome. She's already started using a rail link to Europe to save on shipping costs. If Chinese consumers really cannot buy up unsold stock, the China-Europe link and the New Silk Road will help take these goods to overseas destinations for sale, she says, with the goal of preventing the Chinese economy from derailing. Eunice Yoon, CNBC.
So that's China's Q3 GDP ahead of estimations, but still at a 6-year low. Now, India's leading carrier, Indigo Airlines, is all ready to take off on the Lal Street. The company is geared to raise between 3,077 to 3,245 crore rupees through an initial public offering that commences on the 27th of October. But the pricing of its IPO, its corporate practice when it comes to the dividend policy or dividend payout, and a closer look at its financial statements have raised some concerns. Sonia Shenoy and Farah Bukwala get you the details.
Indigo Airlines has a strange story to tell. By its own admission, it needs no cash. Yet, it is approaching the capital markets to raise funds. Despite sitting on a net surplus cash of more than 3,600 crore rupees, garnered over 7 consecutive fiscals of profitability, it aims at raising the same quantum through its IPO. This begs the question, why approach the capital markets when you can fund your own growth?
In any organization, there is a certain milestone that you have to come to where it creates that legitimacy, if you will. It creates that, bigger, as you said, brand and so on and so forth. For me and the management team, that rigor that comes in, irrespective of what we try internally today, that rigor that comes in from being a listed company is incomparable.
Market experts argue that the IPO, which is priced aggressively at 700 to 765 rupees a share, gives the company a market capitalization of 27,000 crore rupees at the upper end of the price band. But Indigo believes the valuations are justified given that the company has grown at a compounded annual growth rate of 38% and has a predictable growth trajectory for the next 3 to 4 years. But what has the market's disapproval the most is Indigo's dividend policy, which is raising questions on the company's corporate practices. After 7 years of positive net worth, Indigo's net worth slipped into the negative territory in the first quarter of fiscal 2016. That's because just ahead of its IPO, the company has pulled out 1,003 crore rupees from its reserves to pay an interim dividend to its promoters. Ghosh dismisses this as a non-event.
It's a non-event. And I know it's going to sound a little bit flippant, but it is a non-event.
Okay.
The negative net worth is on that day as of the 30th of June. First of all, the cash starts generating again. So the negative becomes positive.
Okay.
We've never had a negative net worth year, and this is our most profitable year. So, put 2 and 2 together and, that will give the comfort.
But this dividend policy points to a larger issue. Since fiscal 2010, Indigo has paid a cumulative dividend of 3,700 crore rupees to its promoters, when total profits earned, excluding MAT credit, was 3,441 crore rupees. This means the promoters have drawn out 260 crore rupees more than the earned profits of the company from its books. Not to forget that the 1,900 crore rupees raised through the offer for sale of 2.61 crore shares will also go to the promoters. The company's decision to pay dividends to existing shareholders instead of paring down its debt of 3,900 crore rupees is raising eyebrows. Indigo's Ghosh says that the fresh issue of 1,166 crore rupees will be used to pare down some debt, but Indigo will strive for a balance between debt and equity. More importantly, the dividend policy will continue.
We've always taken a very pragmatic approach. We've been shareholder focused and at the same time done whatever is right for the business. And that view is not going to change going forward.
But this argument may not cut ice with investors. Many believe Indigo is compromising on the smooth landing of its IPO. In Mumbai with Sonia Shenoy, Farah Bukwala, Vora.
All right, that's the mega IPO Indigo all ready to take off, so watch out for that one. But here's the news that's just breaking. The IRDA, that's the insurance regulator, has issued guidelines for control and for FDI. The total foreign investment, both direct and indirect, in Indian insurance companies cannot exceed the limit of 49%, according to the regulator. The regulator has also said that the law will be applicable even in case the companies do not hike or go up to 49%. So even at 26%, these current guidelines will have to apply once the act is notified. As far as Indian control is concerned, the IRDA says that the domestic firm shall ensure that the majority of the directors, excluding independent directors, should be nominated by Indian promoters or investors, and appointment of key management persons, including the chief executive officer or the managing director or principal officer, shall be through the board of directors or by the Indian promoter. However, key management persons, excluding the CEO, may be nominated by the foreign investor, provided that the appointment of such key management persons is approved by the board of directors. We will, of course, get you more reactions to the clarifications that have just come in from the insurance regulator. Remember, this has been something that has held back foreign direct investment, even as far as existing joint ventures are concerned. So let's see if this does clarify matters for foreign investors. But let's move on now. The Reserve Bank of India's Governor Rajan once again spoke out against the monetary policies of large economies. The easy money policy, which are designed to keep their currencies weak, and negative spillover effects of the rest of the world. Rajan also lashed out against the IMF for applauding such policies instead of questioning them. CNBC TV 18's Ritu Singh gets you more.
Rajan is not one to mince his words. The Reserve Bank of India governor today hit out at the IMF for its lack of action against the extreme monetary policies adopted by the world economies, highlighting the need to push back against such measures.
Extreme monetary policies have the primary effect of altering your exchange rate and pushing capital. They're essentially creating problems for others. We are in a world where there's nothing that prevents these kinds of policies. There's nobody looking at them. The IMF is supposed to look at these things in a global sense, but the IMF has been sitting on the sidelines applauding these kinds of policies right from when they were initiated. And
the problem, said Rajan, lies with the central banks not having a mandate for the world, but only to protect the interests of their own country. And while the distortive policies may initially encourage growth, the effect wears off quickly, leading to a musical chairs-like crisis.
What I meant by the crisis shifting from place to place, that we have, in a sense, a global game of musical crisis, and we have to worry about where this ends.
Rajan argued that the central problem is that of a continued low global growth. The subprime crisis, followed by the European crisis and now the emerging markets crisis, are all just shifting the problem from one country to another. He said today the need for global cooperation between central banks is greater than ever before. In Mumbai, Ritu Singh.
Rajan lashing out at the IMF. On to earnings corner now. HCL Tech has reported a mixed set of numbers. Dollar revenues came in slightly below estimates, while rupee revenue increased marginally. The big miss, however, has come on the profit front. Rima Tandukar now joining us with a detailed analysis of the numbers. Rima, to be fair, HCL Tech a few weeks back had issued a profit warning.
HCL Technologies Q1 FY16 missed moderate expectations, so the company only delivered a dollar revenue growth of 0.5%, a constant currency growth of 1.2% lower than consensus expectations by nearly 50 basis points, and also missing what peers had reported. Remember, this quarter the expectations were toned down because the company had come out with a profit warning on the 30th of September, saying that numbers will be hit on account of a provision, a client-specific factor, some revenue skewness in infrastructure management services. Margins have come in at 20.5%. But if you include the provision hit of $18 million at the operating level, then you get margins of 19.4, 19.5%, and that was what the street was anticipating. So margins net-net are in line with expectations. Profits have declined by 3.2% on a quarter-on-quarter basis at 1726 crore. This was lower than street expectations. But if you see the stock performance intraday at least, it recovered from the day's low, and that's because on a better outlook for the coming quarters. So the management indicated that they will maintain their FY16 EBIT margin guidance of 21 to 22%, which basically means margins should improve from here on. They told us that the order book is 10% higher than the ever before. And apart from seasonality, it's only the softness in India which doesn't contribute too much, which will affect them in the coming few quarters. And this is different. At least this is at odds compared to what peers reported when they'd cautioned about a softer second half of the fiscal year. Apart from the outlook for the coming year, which looks a tad bit better, if you see the stock performance, it's already corrected from levels of 1,000 rupees to 850 on the back of that profit warning. So a lot of the bad news is perhaps priced in, and F517P is only at 13x, which means it's still at a substantial discount to peers.
We look at our margin profile based on a full fiscal, right? I would like to state that our guidance for the full fiscal 16 continues to be in the guided range of 21 to 22%. If you look at this is the first quarter for our fiscal 16, and I believe we've started out a very strong footing. We grew by 13.5% on a constant currency basis Y&Y, so which is very strong for us. If you look at our order book, that also is about 10% higher than what we have previously seen.
Well, that's the HCL Tech management. They're taking us through their quarterly numbers as well as the road ahead. But let's revisit that story. As we told you, this is the news flash that's just come in from the insurance regulator, the IRDA. To make sense of this, joining us now is Vivek Gupta of BMR Advisors. Vivek, appreciate you joining us. We've had a cursory reading of the clarifications issued by the IRDA, and I would imagine you haven't had much time to pore over the details either. On the face of it, do you believe that this addresses the concerns that people have had with regards control, because that seems to have held back the FDI so far?
So I think this whole concept of Indian owned and controlled is something that is now finding resonance in many of our FDI formulations. And this is an interesting concept in the sense that it causes both the foreign investor and the Indian company to stay honest to the 51-49 shareholding ratio. In other words, what it means is that the Indian party must actually exercise the control that a 51% shareholder ordinarily would. And therefore, by providing that the CEO of the company will be nominated by the Indian party, majority board will be nominated by the Indian party, they're trying to evolve a formulation where control is truly Indian. So in that sense, I think this is an accepted methodology. This has been seen in other sectors as well, including media. It has worked in the past, and on a very immediate and cursory reading of the guidelines, I would imagine that this would work here as well.
Well, it is an immediate and cursory reading of the guidelines. Just to get your opinion, Vivek, on some of the issues that the IRDA seems to have articulated, it says here, as far as Indian control is concerned, the domestic firm shall ensure that the majority of directors, excluding independent directors, should be nominated by the Indian promoter or investors. But when it comes to key management persons, excluding the CEO, they may be nominated by the foreign investor, provided that the appointment of such key management persons is approved by the board of directors, wherein the majority of the directors, excluding independent directors, are nominees of the Indian promoters. How would you respond to that?
So in other words, what they're effectively saying in simplistic terms is, let the CEO be an Indian party nominee, but let the junior 49% shareholder get his own professional CFO. That's the way I interpret what you said. And of course, all appointments of KMPs now under the Companies Act are subjected to board approval. On the board, there will be an Indian party which will be in dominance because they will have majority board control. But this allows a joint venture agreement to say that the CEO will be an Indian party nominee, while the CFO can be the nominee of the foreign party.
Vivek, do you believe that it's been almost a year now since we've actually seen the FDI limit being changed as far as insurance is concerned, but even as far as existing joint ventures are concerned, for one reason or another, we actually haven't seen the investment limit being hiked by the foreign partners. Do you believe that this will now pave the way for existing JV partners to move higher?
Yes, and I think a lot has got to do with the fact that there is now objectivity in the guidelines. If I know what my playing field is, I can plan around it. IRDA, by specifying the principles, by specifying the rules actually, on how they would look at control, allow me to now say these are the boundaries within which shareholder agreements can be written up. within which parties can contractually and commercially agree. Given that, I would imagine that some activity would now be seen in the space.
All right, Vivek, we will touch base with you when you have more details and when we also go through the clarifications that have come in. As I said, this is news that's just breaking, so this is a cursory glance at what the IRDA has just put out. But let's move on now to the other big story. Just 3 days after 3 labs gave Maggi noodles the all clear, state governments like Gujarat and Karnataka have acted, lifting the 4-month-old ban imposed on the instant noodles. And different state food regulators have also expressed their anguish over the FSSAI's silence on the entire issue. The Karnataka government has in fact hit out hard at the central government and the national food regulator, saying the main reason for lifting the ban is the ambiguity maintained by the centre. While this is good news for Nestle, you and I may not be able to lay our hands on the popular instant noodles just yet, as the FMCG major still needs to wait for a go-ahead to start manufacturing the product again. They will have to get that approval from the Bombay High Court, which means that the 2-minute noodles will still take time to hit the shelves, even in Gujarat and Karnataka. CNBC TV 18's Purnima Murli caught up with the Karnataka Health Minister and started by asking him on what prompted the state government to lift the ban now.
When we had a contradictory report from the various 2 labs and there was no clarity from the center, we decided to send it to some other state for NABL labs. There was an oral order from my officer not to send the lab to other lab by the FSSAI. So I thought, again, we don't be a part of any unjustified decisions. So anything we should have got a clarity. So until we'll get a clarity and proper guidelines from the FSSAI on the central level, we will withdraw whatever we have implemented. That doesn't mean they'll start tomorrow only. If they are starting it in Karnataka, before they go to the market, that will be again tested, again clarified, then only that will be ready to the market.
2 states have now revoked the ban on Maggi noodles. Let's see when others follow.
Yeah, but what's interesting is in this context, you've got the Maharashtra government saying we're going to appeal against the Bombay High Court orders. So, make what you will of this mess that continues as far as Maggi is concerned.
But moving on, Infosys is clearly on a buying spree. The IT bellwether has announced it will be acquiring Houston-based Noah Consulting in an all-cash deal for 450 crore rupees. The consulting firm is one of the most prominent advisory firms in the oil and gas space and is expected to help Infosys complete its portfolio of providing end-to-end services in the data management business for the energy sector. This is Infosys' 3rd big acquisition in the US since Vishal Sikka took over as the CEO, which has already earmarked $2 billion for inorganic growth via acquisitions.
Well, that was the Infosys stock today, higher by about 1.5%, so that's another acquisition coming in there for the company. But here's another nifty company's earnings. UltraTech Cement succumbed to a bout of profit booking, ending almost 2% lower despite operational numbers coming in above expectations. Profitability, though, suffered due to lower other income and higher effective tax. Nigel standing by with the fine print. Nigel, the stock losing almost 2% today. What do you make of the numbers?
Well, on an operational basis, UltraTech Cement did beat street estimates, though the stock ended lower by 1.5%, getting into its numbers, and for this month itself, it was higher by close to around 12%. To run you through the numbers then, on the top line itself, they registered a growth of close to around 4.5%. That's way better than what the street was working with in terms of a growth of around 2 to around 2.5%, predominantly because the entire top line growth was on the back of higher volumes. Volumes came in at around 11.1 million tons. That's the higher end of the spectrum, delivering a growth of around 4.5%. But what that's telling you is realizations were absolutely flat on a year-on-year basis. Margins as well at around 17.5% came in at the other upper end of the spectrum. So that as well looked quite good, predominantly because power and fuel costs came in lower by close to around 8%, and the management has clarified that the better use of their fuel mix is what led to power and fuel costs dipping on a year-on-year basis. Employee cost, though, was a bit of a dampener. That came in higher by a good 10%. Profitability, though, missed street estimates by close to around 30 to around 40 crores, came in sub 400 crores, but that's because higher taxation as well as lower other income did spoil the party for UltraTech Cement. On the whole, operationally strong performance, while profitability missed because of lower other income as well as higher taxes.
All right, Nigel, thanks very much for joining us with the UltraTech numbers. But coming up, the brand new India Business Hour Plus. Stay tuned to find out more.